Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Welcome. If you're watching the markets right now, it feels like there's this huge disconnect happening. You see major stock indices in the West hitting new highs, but then you look over at Asia and some really important currencies are just, well, they're seeing historic volatility.
That's exactly right. And we're going to drill down into two phenomena today that are, I think, very deeply connected. First, we have to talk about the Indian rupee. There's a structural crisis happening there, and we need to understand why it's so weak when its neighbors are finding their footing.
And the second part.
The second part is this growing consensus, this feeling among global investors that the U.S. stock market, which has been the winner for so long, is frankly just too expensive. And that's pushing money to look for other homes. We're basically tracking the flight path of global capital.
Okay, let's unpack this. Let's start with India. The rupee, the INR, has hit a historic low. I mean, it's a stunning decline. What does that collapse past that big psychological number, 90 rupees to the dollar? What does that really mean?
That 90 barrier was a huge line in the sand, psychologically, and the data confirms it. As of December 13th, 2025, it just blew right past it. It even touched 90.80 in trading.
Wow.
And what makes it so alarming is the context. This is by far the biggest drop we've seen among major Asian emerging currencies this year, while the dollar itself has been trending down a little.
Right, which should be helping these currencies.
It should be. The Chinese yuan, the Korean won, they've been stabilizing, but the rupee is actively getting weaker. It's on its own.
So that's the real puzzle here, this alone in weakness thing. The global environment is supposed to be a tailwind, but for India, it's not. Why is it defying that trend?
It signals a true decoupling. This isn't about dollar strength, not anymore. This is an India-specific structural problem that's just completely overriding any of the positive global trends. The weakness is coming from inside the house.
And the analysis points to two main causes: political risk and this structural capital outflow.
That's the combination.
So let's talk about that political risk, the Trump risk, as it's being called. I think a lot of people would struggle to see how political jitters could suddenly outweigh an economy that's growing at nearly 8%. Why is the market so laser focused on this specific type of risk?
Because it's about stability. The current U.S. administration under President Trump has kept up a very, very hard line with India on a few key issues.
Trade issues.
Exactly. We're talking about things like intellectual property rights and this big sticking point, data localization, where India insists that data from its citizens has to stay on servers within its borders.
Which effectively just killed any hope for a big trade deal by the end of the year.
Absolutely. And the market reads that failure as a sign of isolation. Global capital, more than anything else, it craves certainty. And the perception right now is that India is falling out of favor in Washington while its neighbors are locking in trade deals. That's a huge red flag.
So the strong fundamentals, the high growth, they're being ignored.
They're being heavily discounted because all that growth doesn't mean much if the foreign policy environment is unpredictable. Long-term investors hate that.
And you can literally see that discount in the numbers, in this massive capital flight. Tell us about this money move.
Well, the analysis is pretty stark. It shows over $18 billion has been pulled from the Indian market just this year.
18 billion.
And it's not like that money is just going into cash and sitting on the sidelines. It's being actively redeployed. It is aggressively looking for places with clearer momentum.
So where is that 18 billion landing?
It's heading right to its Asian neighbors, Taiwan, South Korea, Vietnam. They're the big winners here. And you can see the impact. That capital injection is helping to fuel the semiconductor supply chain boom happening across Taiwan and Korea.
So it's a direct trade-off.
It's a zero-sum game. A political risk headache in India is turning into a very real sector-specific opportunity just a few countries over.
Now, what about the central bank? The Reserve Bank of India, the RBI. For a while, they were burning through cash reserves, trying to prop the currency up, but it seems like there's been a major strategy shift.
They had to shift. They realized they were fighting a deep structural political headwind with a finite pile of money. That's a losing battle every time. Defending a specific number, like 90, it just wasn't sustainable.
So they've moved away from that rigid defense and are now just doing smoothing operations. What's the difference?
It's a crucial difference. I think the analogy we've seen is a good one. It's like the RBI stopped trying to hold the water level in a leaky bucket at one exact line.
Okay.
And now they're just trying to keep the waves from splashing over the sides. They're accepting a new lower water level. They're managing the volatility, not the level itself.
And the market sees that as a white flag in a way.
Unfortunately, yes. It tells speculators the central bank has accepted that we're in a 90-plus rupee era, and that can give them more confidence to push the currency even lower.
So if you're a global investor, you're looking in India and you see this high-growth economy, almost 8%, but you're also facing this huge currency risk, this FX loss.
You are, and this is the critical takeaway for you. Even if a stock you own goes up 10% in rupee terms, if the rupee itself falls 15% against the dollar, you, as a dollar-based investor, you've lost money.
But there must be an opportunity there somewhere.
There is, but it's selective. The weak rupee is like a massive subsidy for India's big exporters. Think about IT services firms like Infosys or TCS. If you're a U.S. company paying them, their services just got a lot cheaper for you in dollar terms.
So the strategy is to be surgical.
Exactly. You pivot to the export-focused sectors like IT and pharmaceuticals that get a direct benefit from this exchange rate. You don't just bet on the whole index.
That makes the risk calculation much clearer.
Okay, so if money is fleeing India and it's also looking for diversification globally, that brings us to the second part of our story. Why is the U.S. market suddenly being questioned? Here's where it gets really interesting. Yeah, and the questioning of the U.S. market, it's purely a valuation issue. It's a burden of success, really. Recent analysis shows the S&P 500's forward price-to-earnings ratio is sitting around 23 to 24 times.
Okay, that number, 24 PE. Let's break that down for the average investor. What does that actually mean? Why should that number make somebody nervous?
It's a great question. It basically means investors are willing to pay $24 today for every single dollar of expected future earnings from those companies.
And how does that compare to, normal times?
Well, the historical average over the last 20 years is closer to 17, so we are way above average. We're at a premium that's only been seen at extreme peaks, like right before the dot-com bubble or during that liquidity craze in 2021.
So just to be clear, the concern isn't that U.S. companies have suddenly gotten bad?
Not at all. U.S. tech, U.S. innovation, it's still world-class. The problem is that all of that good news, all that future growth, it feels like it's already priced into the stocks today.
There's no room for more good news.
Exactly. The market is demanding perfection. And that leaves very little room for a positive surprise, but it dramatically increases the risk if companies just meet expectations instead of blowing them away.
I think that large cap versus small cap analogy that's going around Wall Street is really helpful right now.
It simplifies the whole dynamic perfectly. In the analogy, the U.S. market is the big, stable, high-quality, large-cap stock in your global portfolio. It's the anchor, but it is pricey.
And the non-U.S. markets are the small caps.
Right. Europe, Latin America, parts of Asia. They're the more volatile, but much, much cheaper small caps.
So why is money flowing from the expensive large cap to the cheaper small caps right now? What's the catalyst?
The catalyst is the Fed. The Federal Reserve has clearly started a rate-cutting cycle here in late 2025. And historically, when that happens, the dollar tends to weaken and global liquidity, the amount of money sloshing around the system, increases.
And that money looks for a bargain.
It flows directly toward those cheaper small caps where it can have a bigger impact, seeking higher potential returns. And the sources we're seeing don't view this as a short-term trade. They see it as the start of a multi-year global rebalancing.
So let's look at some of those alternatives. Japan is a real standout. They're talking about a structural re-rating. How is Japan pulling that off after, decades of stagnation?
It really is a fundamental change. It's three things coming together at once. First, the super weak yen makes their huge export companies incredibly profitable. Second, they're finally getting real wage growth, which is boosting local spending. But the biggest deal is corporate governance reform.
Explain that. How does better governance translate into higher stock prices?
For years, Japanese companies were famous for just hoarding cash, inefficiently. The Tokyo Stock Exchange has been putting immense pressure on them to use that capital better by demanding they buy back more of their own stock, pay out bigger dividends, or sell off divisions that aren't performing. This shift from just holding cash to actually maximizing shareholder value is fundamentally changing how global investors see Japan. It's being reclassified as an undervalued developed market with real long-term legs.
That's a huge narrative change.
Okay.
Let's pivot to the resource nations. Latin America.
Countries like Brazil and Chile, they are basically a leveraged bet on global industry. As global rates fall and the dollar weakens, commodity prices for things like copper and gold are expected to rebound. These countries are the direct beneficiaries.
So it's a way to play an industrial recovery.
Exactly. A way to do it outside of the usual tech and finance sectors.
And what about the rest of the world? Europe, other parts of Asia?
For Europe, the expectation is that they've finally hit the bottom and are starting to recover, helped by big investments in defense and infrastructure. In Asia, it's still about being selective. South Korea and China look cheap compared to the U.S., but you still have to be disciplined because of geopolitical risk in Korea and policy uncertainty in China.
Let's touch on the political overlay again, but this time from a global view. You said the market sees the U.S. hardline on India as a severe local shock. But globally, the data suggests that the possibility of the current administration continuing, it's now seen as a manageable risk, not a crisis.
And that's a crucial distinction. The shock value is gone. The market has had years to digest the policy approach. The view now is that we probably won't see a return to the huge, broad trade conflicts of 2018 or 2019.
So that lowers the temperature.
It lowers the psychological pressure on global trade, and critically, it allows these non-U.S. markets to trade more on their own fundamentals, which are improving.
But, and this is a big but, if we connect this all back to our first topic, the central lesson has to be that investing outside the U.S. carries serious currency risk.
We have to reinforce that, absolutely. The Rupee crisis is the perfect, painful example of how a high-growth story can have its dollar returns totally wiped out by the currency. If you're looking at Japan or Latin America, hedging that currency risk isn't optional. It's mandatory.
And the resource nations have their own specific risk.
Right. They are directly tied to commodity prices. If for some reason global demand suddenly slows, those markets will get hit, and probably even faster than the U.S. market would.
Okay, so we've covered the risks, the opportunities. Let's bring it all home. What's the key takeaway here?
Yeah.
What should you be thinking about for the next year?
I think the main thing is to understand we're in a phase of global portfolio optimization, not a panic. This isn't about fleeing the U.S. because the economy is collapsing. It's about optimizing the U.S. weighting because the valuation has just gotten too stretched.
It's gotten ahead of itself.
Way ahead. And non-U.S. markets are gaining traction now because they were, frankly, excessively cheap, and now the conditions are finally right for their valuations to start catching up.
So the key action point for you, the listener, really seems to be about balance. The rational approach for 2026 is balancing your U.S. holdings, which are still your core for stability and quality, with strategic diversification into these non-U.S. markets.
You should see Japan, the resource nations, and parts of Asia as strategic buffers against that U.S. overvaluation risk. It's about building a more robust, balanced portfolio that can handle what's coming.
So a final thought. If the price of copper is what drives growth in these resource nations, and those nations are now needed to stabilize global portfolios, does that mean the strength of global growth now hinges more on industrial metal demand than it does on big tech innovation? Something to mull over as you build your strategy for the year ahead.
Always more to think about.
Thank you for joining us for this deep dive into the shifting currents of global finance.
We hope this analysis provided you with the clarity needed to navigate these complex market shifts.
Don't forget to subscribe and hit that like button.